The average American household earns about $5,000 a month, according to the Bureau of Labor Statistics. Most people believe replacing that income in retirement requires saving $1 million or more, an intimidating goal that feels out of reach. But what if there is another path? What if I tell you that with just $7,000 to start and the discipline to redirect money from a few forgotten subscriptions, you could put a powerful wealth-building strategy into motion, one with the potential to create lasting financial security and dramatically reduce your dependence on a paycheck. In this video, I will break down the lowest amount you actually need to live off Fidelity index funds, and you could be super surprised that it's probably less than what's sitting in your checking account right now. I'm going to show you and Bobby how to build a passive income portfolio using Fidelity dividend index funds that can one day replace your entire paycheck. In addition, I'll cover the biggest mistakes people make when chasing dividend income. Also, I will explain what makes the funds on my list unique, and I will reveal the minimum amount you need for this portfolio to pay over $63,000 in annual dividend income, and finally show you and Bobby a simple strategy to hit that same milestone a full decade earlier. If financial independence is one of your goals, this is the video you do not want to miss. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Before we get into the numbers, let's talk about something real for a second. Think about what financial freedom actually means to you. Not the bumper sticker version, the actual version. It means watching your parents age and being present for it, rather than being trapped behind a desk. It means waking up on a Monday morning without that familiar tightness in your chest. That's what we're building here. And the vehicle that makes it possible, more than almost anything else available to everyday investors, is the index fund. When most people think about building wealth, they picture rental properties, hot stock picks, or throwing money at crypto and hoping a tweet doesn't erase it overnight. Those strategies can work, but they come with enormous risk, relentless stress, and far more fine print than anyone admits up front. Real estate sounds solid until you're dealing with tenants who disappear, appliances that fail at midnight, and property managers who quietly drain your returns. And crypto? A single tweet from the wrong person can erase months of gains in minutes. These aren't investment strategies. They're gambling with extra steps. Now compare that to low-cost index fund investing. Instead of betting everything on one company, you own hundreds of them at once. That spreads your risk automatically and smooths out the volatility that makes ordinary investors panic sell at exactly the wrong moment. There's no obsessive news watching, no sleepless nights, no guessing. You buy, hold, and let time do the heavy lifting. It is the only strategy in the world that genuinely works while you sleep. But before you start picking funds, there's a critical mistake you absolutely must avoid. The moment most people hear dividend investing, they go hunting for the highest yield possible. A fund paying 7%, 8%, or even 10% looks like a dream. But here's what nobody tells you. Those numbers are often a trap. High dividend yields frequently signal elevated risk and dangerously weak fundamentals. When a fund is offering unusually high payouts, it's usually because the market doesn't trust it to grow. In many cases, the share price is stagnant or actively declining, and investors are being compensated for that decay with a bigger check today. But when that dividend gets slashed, or the underlying investment collapses, that so-called safe income disappears overnight. You're left holding a damaged portfolio with nowhere to turn. This strategy flips that mindset completely. Instead of chasing short-term yield, you focus on total return, a powerful combination of dividend yield, dividend growth, and share price appreciation working together. It's not about what you earn today. It's about how much that income grows over time and how much your portfolio is worth a decade from now. Here's the math that makes it crystal clear. A fund with a 2.5% yield that grows its dividends at 15% annually will absolutely destroy a stagnant high-yield fund over any meaningful horizon. Compounding multiplies both your reinvested dividends and your future income simultaneously. That's how you build a passive income machine that scales alongside your life and eventually overtakes it. So how do you pick the right index funds for long-term dividend growth? This portfolio is built on 3 core principles designed to maximize total return over a long horizon. First, reliable dividend yield. Steady, healthy payouts that aren't so low they're meaningless, and not so high they signal danger. Second, strong dividend growth. Funds that keep raising their payouts year after year compound dramatically faster. A 15% dividend growth rate means your income doubles roughly every 5 years. That is an extraordinary engine for building generational wealth. Third, share price appreciation, because this isn't just a cash flow play. A growing portfolio protects your purchasing power against inflation and builds real net worth even if you never sell a single share. And the glue holding everything together is diversification across market segments. US mid-cap stocks, extended market exposure, large cap stability, total market breadth, and sustainable ESG-aligned companies. That blend captures growth from every corner of the market while spreading risk across multiple dimensions. Now, let's review each of the 5 funds and understand exactly why each of them earned its place in this portfolio. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. The first is the Fidelity Mid-Cap Index Fund, ticker symbol FSMDX. This is the engine room of the entire portfolio. Mid-cap companies sit in a sweet spot that most investors overlook. They're past the fragile startup phase where businesses fail overnight, but they haven't yet grown so large that their best days are behind them. These are companies still hungry, still expanding, still grabbing market share. That's exactly why FSMDX carries a 23.67% dividend growth rate over the past decade, one of the highest you'll find in any index fund in this category. Its 2.27% dividend yield gives you a meaningful paycheck today, and its 6.53% average annual price appreciation means the fund itself keeps climbing in value. Every year you hold it, you get paid more. That's the income grower. Next is the Fidelity Zero Extended Market Index Fund, ticker symbol FZIPX. Think of this fund as the diversification layer that most portfolios are missing. While the S&P 500 gets all the headlines, thousands of smaller, high-growth companies across America never make that list, and FZIPX owns them. It carries a 1.19% dividend yield and a nearly 20% dividend growth rate, meaning the income it generates is expanding at a serious pace, even if the starting number looks modest. Its 5.08% annual price appreciation provides stabilizing ballast to the portfolio, smoothing volatility without sacrificing long-term upside. The third unique fund is the Fidelity Zero Large Cap Index Fund, ticker symbol FNILX. This fund is often noted as the steady anchor every great portfolio needs. This fund tracks the largest, most battle-tested companies in America, businesses that have survived recessions, inflation spikes, pandemics, and every market crisis you can name. They don't just survive, they keep paying and growing their dividends through it all. FNILX delivers a 1.02% dividend yield, a 17.21% dividend growth rate, and an exceptional 12.0% average annual price appreciation. That price appreciation number is the standout here. It means the value of your investment is compounding faster than almost anything else in this portfolio, quietly building your net worth in the background while you sleep. Fourth is the Fidelity Zero Total Market Index Fund, ticker symbol FZROX. This one is the broadest net you can cast across the entire American economy. When you own FZROX, you own a piece of everything: large caps, mid caps, small caps, growth companies, value companies, every sector, every corner of the US market in a single zero expense ratio fund. Its 1.09% starting yield is not the headline act, but its 19.2, 1% dividend growth rate, and 11.6% annual price appreciation absolutely are. This is the fund that accelerates compounding without adding concentrated risk, because when you own the whole market, no single company's failure can derail your progress. And finally, the Fidelity US Sustainability Index Fund, ticker symbol FITLX. This fund completes the portfolio with both purpose and performance. ESG investing is no longer a niche idea. It represents where institutional money, sovereign wealth funds, and long-term capital are actively moving. FITLX captures that momentum with a 1.22% dividend yield, an 18.07% dividend growth rate, and 10.68% annual price appreciation. It delivers inflation-resistant, stable returns while positioning your portfolio on the right side of global capital flows over the next several decades. When you combine all 5 funds together, the numbers tell a remarkable story. This portfolio delivers an average dividend yield of 1.36%, a 10-year dividend growth rate of 19.62%, and annual price appreciation of 9.22%. None of those individual numbers is extraordinary on its own, but together they form something powerful. The dividend yield gives you income today. The 19.62% dividend growth rate means that income nearly doubles every 4 years. And the 9.22% price appreciation means the total value of your portfolio continues to climb. That 3-part combination, yield, growth, and appreciation working simultaneously, is exactly what transforms a modest starting investment into a genuine financial independence machine over time. Now let's get to the numbers that Bobby has been waiting for. Here's what happens when you start with a $7,000 lump sum and add just $5 a day. Firstly, let's point out that a committed $5 per day plan will add up to $150 per month and $1,800 per year. By year 10, Bobby would have contributed roughly $25,000, but his portfolio would be worth approximately $51,400. That's more than double his total contributions in a single decade, powered entirely by compounding returns and growing dividends working silently in the background every single day. Then comes year 20, and this is where something shifts emotionally, not just financially. Bobby's total contributions will be around $43,000, but his portfolio would have grown to around $240,000. The gap between what he put in and what he'll have is no longer a rounding error, and his portfolio would be generating a growing stream of dividend income that gets recycled into more shares, which generate more dividends, which buy more shares. The flywheel effect is fully engaged, and it becomes nearly impossible to stop. By the end of year 30, the transformation is complete. After Bobby's total out-of-pocket cost will be approximately $61,000, but his portfolio will be worth over $1,050,000. The annual dividend income his portfolio will generate at that point will exceed $63,000. That's more than $5,250 every single month for the rest of his life, without ever selling a single share. Let that sink in for a second. $1 million passive income machine built using just a one-time $7,000 investment and a daily commitment of $5, an amount less than the cost of a cup of coffee. Now, let's say Bobby wants to reach that same financial freedom goal 10 full years faster. Let's say his target is by year 20 instead of year 30. Here's what that looks like. He will have to start with $20,000 up front and commit to $20 a day or $600 a month. More aggressive, but still an achievable number for a disciplined investor who is serious about getting their life back a decade earlier. Based on this number, by year 10, Bobby will be sitting on roughly $185,000, with dividends growing at double-digit rates every year. And by year 20, his total contributions will be around $166,000, but his portfolio will be worth approximately $915,000. At that point, the annual dividend income will be approximately $68,700, or about $5,725 per month. Even if he chooses to spend those dividends rather than reinvest them, his portfolio will still be worth nearly $750,000. With this projection, Bobby will hit financial independence a full decade ahead of schedule. Picture what that actually means. 10 extra years of freedom. That is what the right dividend growth strategy can buy you. The path Bobby is walking starts with one decision. A decision to stop waiting for the perfect salary, the perfect moment, or the perfect market conditions. You definitely do not want to watch this opportunity from the sidelines. So, please let me know your plans in the comments below. Now, if you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Listen, if you want to know the 5 best Fidelity index funds to buy and hold for life, or the 5 best high-yield ETFs for monthly dividends with zero NAV erosion, check out the videos on your screen right now. Thank you, my friend.